buy now, sell now, the market is crashing, you're running out of time. Whew, oh boy. All of this market noise is not only confusing, it's exhausting. And what's wild is it's not helping you become a better investor. Wealth through investing is built over time. It's built by investing consistently over a long period of time. It's making calm, rational decisions about what you want to buy. And it's not rushing or trying to get the best price right now before the price changes. It doesn't have to be that way. The people that are making the loudest noise in the market, they're often not the ones that are really building wealth long term. Sure, they might be making a few thousand here or there, but they aren't building long term wealth. So, how do you actually do that? So while you can take advantage of some market movements when the price goes down, I like to call that a sale, you don't have to catch every move. You don't have to catch every dip, every high. Missing one opportunity does not ruin your investing future. We all know that cliche, time in the market is going to beat timing the market every single time. And it's a cliche because it's actually true. The problem with trying to time the market is it's very difficult to do. Very often investors, even experienced investors, get it wrong. And it's very easy to look back and say, I should have sold here, I should have bought here. Hindsight is one of the greatest investors, but not all of us have that crystal ball. So I prefer a more calm approach. I don't like emotional investing because every single mistake that I've made in the market has been because I've tried to rush a decision. It's because I've listened to all the noise, and that is where I've always made a mistake. Whereas the times where I've been calm, consistent, and just invested no matter what the market is doing is the time I've done the best. So let's ground your investing strategy into your lifestyle. The first step is just working out how often that you can invest. Maybe you invest monthly, maybe you can invest weekly, or maybe you only invest 3 or 4 times a year. The time frame isn't quite as important as long as you have that consistency. Then your investing becomes more like a dollar cost averaging strategy where you get to buy more when the price is down and less when it's up. So it evens things out. You're not stressing about price so much because if it stresses your life, it's not going to last. You're going to give up. The market's going to go down, you're going to panic, and you're going to stop investing completely. So create a system. Pick a day each month that you're going to invest. Maybe that's the first of the month, maybe it's the middle of the month. It doesn't really matter. You might want to time it around when you get paid. You might want to time it around when you save up a particular amount of money. This is going to reduce that decision fatigue. If it's in your calendar, that means you're going to do it. It's scheduled. It's getting done. You want your investing to become a routine, something you do every month or every quarter, rather than just reacting to whatever the market is doing. Now let's kill that complexity pressure and just keep our portfolio of what we're going to buy simple. Now, while I often recommend single stocks on this channel, you do not need to invest in single stocks. You don't need to have multiple ETFs. You can just have one ETF. That makes things simpler for you, and it means that you're going to stick with your investing plan. Dozens of stocks is fine for some people, but it's not for everybody. So you need to get out of your head that you need this perfect portfolio of every single amazing company there is out there, because it doesn't exist. Sure, some companies are better than others. All you want your portfolio to do is build you wealth over time. So one ETF is perfectly fine if that's your preference. If you are only having one ETF, then choosing something that's a broad market index ETF is probably the way to go. So something that follows the ASX 200 or the ASX 300, or you can choose a dividend focused ETF. Even though I like individual companies, you never have to invest in individual companies if you don't want to. I invest in individual companies because I like that way of investing. I like being able to choose which companies go into my portfolio. It is my preferred way of investing. But comfort in investing is way more important than complexity. So with this style of investing, one of your key components is going to be patience. And yes, patience is going to be a strategy. This means that you're not rushing to make any decisions. You're just making regular contributions into your portfolio, whether that's an ETF, whether you're buying new companies. Over a long period of time, you're keeping that consistency. This is the heart of growing a healthy, stable portfolio. Your first priority should be building that stable foundation of good companies that are going to have long-term growth and, of course, long-term dividends if that's the way you're going. Once you have a healthy base in your portfolio, you can play around a little bit more then. You want to build the base first, and then you can introduce some variety and some more fun if you want to, but you don't have to. Now, it might be that you want to invest, but you're not quite ready yet. If this is the case, then start a test portfolio. You can do this in a watch list or in a spreadsheet or even in your notes app. You can go through the process of what you would buy, what you're thinking of buying right now. So you do the research, you decide which companies you're going to buy or which ETFs, or even just one ETF if that's the way you're going to go, and you put it down into your spreadsheet or your notes app or your watch list. And you're not going to do anything for the next 6 to 12 months. The reason most people don't start investing is because they're either scared they're going to make a mistake or they feel like they don't know what they're going to do. So having this test portfolio is going to eliminate those fears. So during the 6 or 12 months, you're going to look at what the price does. You're going to make a note of any of the dividends that you would have received during that time. And then you can analyze that after the time frame, make changes if you want to, but you're not committing real money. Think of this as your education into investing, because this learning is going to make you a much more confident investor. Yes, investing early is powerful because the time in the market is going to compound and you will make more money over the long term. But it's not if you're not comfortable with investing right now. Starting when you're confident and calm is an even better strategy. You want to eliminate the fear that you're going to lose your money overnight or you don't know what to invest in. Those investing blocks are going to be removed if you remove the pressure on yourself to have this perfect portfolio. You want to make investing something that's stable and calm and works in the background. So you don't have to rush decisions. You can make a calm, consistent choice every single month or every single quarter, whatever time frame makes sense to you. And you don't have to rush the latest stock tip either. Calm, intentional, consistent investing is the way to build a healthy, stable foundation in your portfolio and build wealth long term. I hope you've enjoyed this topic. I'll see you in the next video. Bye.